Well, hi, everybody. I'm Don Prattle from TradeStation, and I hope you had a good trading day today. Today, we want to put one of the premier trading consultants in under the spotlight here at TradeStation to help you tomorrow. AJ Monte is one of those most sought-after speakers in our field. He teaches professionals specialized technique on how to accumulate, protect wealth through innovative market techniques. He's got many years, decades in our business, at least 10 of which were served as a trader on the floor of the New York Commodities Exchange, where he specialized in gold and silver options. During his time on that trading floor, he served for 2 years as the chairman of the Option Floor Trading Committee for COMEX. He left the floor in 1982 to trade NASDAQ stocks from Mayer and Schweitzer and Nash Weiss, which is all part of Bank of America these days. Several years later, AJ pioneered the Trading Analytics Group for Charles Schwab, which is a team of professionals who educate both clients and high-profile brokers in the areas of technical and fundamental analysis. For 2 years, AJ was the co-host of the PBS weekly show Wealth and Wisdom, which he co-hosts, which also co-hosted the top-rated on-demand radio show, the Market Guys podcast. His travels in our industry bring him all over the world to teach people how to manage risk by using technical analysis. He's also a movie star, and I'll let him talk to you about that. I'm sure that's part of his outline today. Now, everything we talk about here in this presentation is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are for demonstration purposes only. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where TradeStation is not authorized to do business. Remember that active trading may not be suitable for you. Now, options trading carries a high degree of risk and may not be suitable for all traders. I've included in the chat panel a couple of pieces of disclosure information that I urge you to take a look at your leisure. They are the Options Clearing Corporation's Characteristics and Risks of Standardized Options brochure, and also an article from TradeStation regarding the asset classes that we trade here. Now, that brings me right down to the Market Guys opening here, where AJ Monte is going to take over, and he's going to explain to us how to leg into options spread trades. AJ, thank you so much for spending time with us today at TradeStation. It's very much appreciated.
Thank you very much, Dr. Don, and I appreciate that introduction. As far as being a movie star, I think that's a far reach. While I have dabbled in the industry of producing movies, I think my stardom was limited to just being an extra in a couple of films. One of which is Trading Places. I don't know how many of you who are listening to me now had the opportunity to watch that movie, but it seems as though every year, right around December, right around the Christmas holiday, Trading Places seems to show up somewhere on AMC or one of the movie channels. And boy, I wish I had known then how popular it was going to be. I would have pushed for a speaking part and got some royalties out of it. But yeah, that was the extent of my involvement in the movie industry. But it was during that time when John Landis, the producer of that film, came to Wall Street, and they actually filmed that on the trading floor itself in the World Trade Center. And interestingly enough, a lot of the floor traders were hired to be in the film to create the atmosphere of what it was like to be on a trading floor at the time. And while the open outcry system is becoming more of a thing of the past, the concepts of trading still live very much and are very much alive in the markets itself. And I've followed strategies, and especially when it comes to trading, I followed the same strategies for 36 years now, and my biggest loss came in the crash of 1987, and that was long before I had the discipline to put together a risk management plan to limit my losses. But since 1987, since that year of the loss, my big loss, I have not had a losing year in any year since 1987, which is pretty remarkable when you think of the volatility that we've been up against lately. This is just a quick slide to let you know that the content that I am going to present to you today is content that I put together over a number of years, and it is for educational purposes. So this is more or less our gift to you, the trader, the client of TradeStation, and I would invite you once again to sit back and relax and take some notes. Now, towards the end, if you would like a copy of this presentation and one of my actual trade alerts, up-to-date trade alerts, I'll give you some information on how to get that towards the end. So if you could stick around to the very last slide and I'll get that to you. But I am very much a type of person who looks at the numbers. I'm a numbers cruncher. My degree, my educational background is in aerospace engineering. It was not anything to do with financial anything, not trading, not investing, not money management. I went to college to learn how to fly planes. I went into the Navy shortly after that. I wound up flying. I continue to fly, and I manage risk in the market like I manage risk before I get in an airplane to take off. I use checklists, and I follow good, strong disciplines to make sure that my stock portfolio is not going to crash and burn because I made a mistake by holding on too long. Everything that I'm telling you about here today, everything is grounded in what I've created as the 1% rule for managing risk. Now, there have been some people that tried to copy this and change the name of it. Some have changed it to the 2% rule. Some have taken it to the 4% rule. The 1% rule is my rule. I created it back in 1987, right after I lost everything, and I said I'm never going to let that happen again. And I invite you to go and review the 1% rule for managing risk. If you look at this, there's a hyperlink attached to the screen. So if you get the PDF document, it'll bring you to the Market Guys page, and then you click on the video tab and it'll bring you to the 7-minute video that explains that rule for managing risk. So I invite all of you, whether you're listening to me live or recording, I invite all of you to review that. It cannot hurt. It can only help. Now, let's get into some of the meat of what we're talking about here today. These are the bullet points of what I'm going to cover. With the exception of the last one, I don't know if I'll be able to go to live charts, but I'm going to go to my live trading screen where I've archived my what I call the trade blotter. I'm going to show you trades that I've even done today, right up to date with what we're doing here, recording this on October 2nd. And I surely hope you'll ask me questions along the way. This is an open platform right now for the people who are attending. So if you have a question for me, type the message to me or question to me at the bottom of your screen. It'll say type message here. You can type that. We'll be monitoring the questions, and I'll be able to do my best to answer the question along the way. So feel free to challenge me on that level. Now, defining what legging is, this is not an unusual term. This has been a term that's been used by option traders since options were created back in the 70s. And I'm going to be covering what the term legging is and the types of spreads that are best to leg. And then I'm also going to talk about the risks involved, because there is nothing that I'm talking about here today that has zero risk. Everything that I'm presenting to you on these slides, everything has risk somewhere involved with that particular trade or analysis. So if we understand that from the very beginning that there are risks, we can then work our hardest to minimize or even mitigate that risk by looking at the technical signals before we get into the trade and before to the spread. So again, remember that if you follow the rules and analyze the charts according to what I'm going to show you, again, there's no guarantee you'll make money, but it definitely puts the odds in your favor when you can get an eyeball on who's controlling the price action at that particular point in time. Again, here we go. Legging the spread. This is, I should have disclosed my source here. This is from Investopedia. This is their definition of what legging the spread is. And they basically say that in the world of trading, legging in involves establishing an option spread one leg at a time rather than as a single transaction. So I need to back up just a little bit to tell you that an option spread has two legs to it. It has a long side, which is the first leg, and the second leg is the short side. So when you have a long side pitted against the short side, it's somewhat of a hedge. It's not a perfect hedge, but there are two legs involved. So when we are looking at a particular chart, we can time it as such so that we can initiate at least one side of the leg before the second side is completed. And what you're doing is actually increasing the profitability while at the same time reducing the risk. Now, because we only have about 38 minutes left, I'm sorry, 48 minutes left. Am I correct? Oh wait, we started at 4:30. So we have about 48 minutes left before I wrap things up. So in essence of time, I'm only going to be covering spreads that are the most popular in my trading world. Okay, these are the three spreads that I tend to leg into the most. First is a covered call, and that's also known as a buy right. Now, let me hit the pause button before I go on to the next two bullet points. If you are brand new to options, don't worry if I lose you on certain terminology. This is more or less a warm-up or a prelude to what I'm going to be talking about when I make my trip to Chicago. TradeStation and Don Prattle and his team have invited me to speak to the group of clients that will be showing up in Chicago. And if you plan on being there, I'm telling you something, this is going to be one heck of an event. And I can promise you this. Here's one guarantee that I will make. If you show up to the All-Star Option Conference in Chicago on October 19th, I can promise you, you're going to leave there with very valuable information. You're going to be charged up because my presentation style tends to involve the audience. I'm not just one to stand up and stage and just talk. I will have a number of exercises that you'll be going through. I'll have a bunch of pictures and references that will help ground you in these concepts. And it's going to be very, very different than any other type of presentation you've done in the past. So I hope you can make it there. If you're out of state, I think it's worth your time and money to get on a plane and book a hotel room. It'll be worth your time and the price of a hotel room to get there. I promise you that. So a covered call is when you buy the stock and then you sell another call or an option against it. So the action of selling an option is called writing the option. And when you buy the stock and write an option, you put those two together, you are taking risk on the long side and you're trying to more or less offset some of that cost basis on the short side. When I'm doing a vertical spread, it kind of changes things a little bit where I'm going to talk about a bullish call spread. I could even talk about bearish call spreads. But a vertical spread, basically what it does is it limits your loss to a fixed amount, but at the same time limits your profits to a fixed amount. So it's kind of locked in on the risk side and the reward side. And it's not very complicated. It will take some time and some study to learn how to trade vertical spreads. And my all-time favorite, and I'll show you again when I get to my actual trade blogger to show you my actual trades, diagonal spreads is where I make the most money. These are the biggest profits that I pull in, because again, this is based on my opinion, the diagonal calendar spread allows more profit than covered calls and vertical spreads because you're not locked into a max profit area. You could move with the price of the stock and more or less morph the trade into something bigger and better each and every month. On the other side, when a trade starts going against you, the diagonal calendar spread allows you a lot more flexibility with regard to changing the position in your favor, even when the price of the stock is moving against the overall position. All right, so again, look at my note there. The examples that I'm going to be highlighting are going to be bullish spreads, but if you want to play the market on the bear side or the downside, all you have to do is follow the technical signals that would give you bear indications, and that's pretty much how you would change that. All right, now I just want to point this out. Dr. Don Prattle put a registration link for the Traders Option All-Star event there. If you want to register for that, just click on that. And I do believe that hyperlink will open up a separate window. And if you do that, and you could bookmark that or save it for when we're done here, and you could register after that. So again, just pointing that out to you. Now, again, starting with the covered call, I'm using basic examples, and you'll notice that in my example here, I'm not talking about the month of that particular option, and I'm not even announcing a ticker symbol. These are just numbers that I've pulled out, out of my hat randomly to show you the example of what could happen when you do the trade straight as a simultaneous trade versus doing it as a legged-in trade, where you initiate one and complete it at another time. All right. So in step one, what I am doing here, and you can follow my bouncing red dot here. In step one, when you're doing a covered call, you're buying the stock for whatever price. In this example, I'm buying the stock at $40. And in step two, I am simultaneously selling a $45 call. Now, let me explain step two and what this whole process is all about. When I sell a call, I am obligating myself to sell the stock at the strike price that I've sold. So if I buy the stock at 40, I am now obligating myself to sell the stock $5 higher than when I bought it, where I bought it. So I think, for the most part, I don't think anyone's going to have a problem, at least on this presentation in this audience. I don't think anyone's going to have a problem buying this stock one day and selling it $45 the next and making a $5 profit on a $40 stock. I don't think anyone would have a problem with that. But if I sell a $45 call, I will actually collect a premium. And in this example, the premium I'm collecting is $2. Now, there's two ways you can look at this. You can look at this as me lowering my cost basis from 40 to 38, because again, if I'm buying the stock and then immediately collecting $2, I can lower my cost basis by 30 to 38, which then puts my net debit to 38, which is, by the way, what my risk is. Whatever I'm spending on this net debit transaction is what I am risking. Okay, so there's the basic explanation of what a covered call is. Now let's move forward, and if anyone wants me to go back and review, feel free to do that. I'm still scanning here to see if there's any questions. Go right ahead. Again, type those questions in if you have them, and I'll be watching for that. Okay, so there we go. A simultaneous trade where I buy the stock at 40, sell the call at $2. Now, let's go to the drawing board here. This is a fairly recent stock chart. I pulled this just a couple of days ago, and I want to point out to you some of the signals that I'm seeing on the chart. Now remember, my goal is to leg into this covered call. And my goal is to get a higher credit on step 2. All right, so step 1 is all the same. I'm going to buy the stock because of the signals that I found on this particular chart, but my goal is to wait just a little while, allowing the stock to rally, because the signals that I'm seeing here are bullish in nature. So I'm going to buy the stock, let it rally, and then what I'm going to do is sell the call in an effort or an attempt to collect more on the sell side. Now, let's point this out. Bullish engulfing candles. I love them. I cannot overemphasize my excitement about when I see an engulfing pattern like this, a bullish candle, a big candle. I cannot overemphasize the importance of gaps and how they act as price magnets. I cannot overemphasize enough the importance of stochastics as a leading indicator, or at least an indicator of overbought, oversold, with some buy signals and sell signals thrown into the mix there. This is an actual snapshot of what my charts look like. I have a blue line that runs through the price action. That's a 20-period moving average. I have a volume indicator. I'm always looking at volume, and about 95% of the time I will have stochastics on there as a lower indicator on the chart. Now, if I see a bullish candle, like I see here, like a big green candle right there, I immediately look down to see what's happening with the volume. And you can see here that on this particular day, the candle is green, but the volume has spiked quite dramatically. Now, the significance of this is such that the spike in volume is telling us that the buyers are motivated. Okay, that's what volume tells us. The volume gives us a gauge for the level of motivation behind the buy or sell side. If the volume is low on this particular green candle, I'm not going to be as excited as much as I am when the volume is high. And Eden says, is the stochastics fast? No, this is a slow stochastic. I use the slow stochastic because it gives a clearer, crisper buy signal. It kind of smooths out the volatility in the indicator. So I use slow stochastic. Thank you for that question. Now, the other signal that I'm seeing on the chart that tends to be bullish is you'll notice that the blue line here, this moving average, has been going in a downward direction, and then the moving average starts to flatten out and go sideways. You see this? So when the price action starts closing above this moving average, that is a bullish indicator. Years ago on my television show, Wealth and Wisdom, that aired on PBS, I had a guest by the name of Jim Rawbach. Now, at the time, Jim was known as the Zen of market timers. He had the most accurate forecasting record for stocks in the world, and all he did, listen to this, all he did was track the price against the 20-period moving average. He didn't use any of these indicators, or he didn't even look at volume. He just looked at the price and how it moved up above the moving average, and when it dropped below the moving average, he would be out. So when he saw a stock closing over the 20-period moving average, he would buy it. He would then trail his stop as the stock went up and either close the stock when it started dropping below the lows of his trailing stop, or he would close out of the position if the stock dropped down below that 20-period moving average. That's all he did. Looked at the crossover at the 20-period moving average. If it crossed above, he bought it. If it crossed below, he sold it. Done. And he was one of the most accurate, if not the most accurate in the world. The Zen of market timers. So there we go. We have a green candle on high volume crossing over the 20-period moving average. The stochastics is showing a buy signal. When the blue line crosses the red line, that's a buy signal. And there is a gap above the market. Now, if you go to themarketguys.com, you see the website down there. If you go to themarketguys.com and click on my video tab, I have a library of videos, and one of the videos is entitled Trading the Gap. And it's a 7-minute video. Go and review that video so you can see how accurate gaps are with regard to being price magnets. There are two rules when looking at gaps. The first rule is 80% of the time, 80% of the time, gaps will fill. The second rule is 80% of the time after the gap fills, the price will reverse. Again, 80% of the time. Here's an example. Back here, see how the stock gapped down? Well, the gap filled here. See the gap? I hope you can see this. I hope it's not lagging too, it doesn't take too long of a lag time. But here the stock gapped down. Here the gap filled. So there's 80% of the time the gap will fill. 80% of the time after the gap fills, like it did here, it will reverse. Boom, what happened? It reversed. Here is another gap up. You see that? 80% of the time it will fill. It filled here. Shortly after that, what happened? It reversed. Here's another gap right here. 80% of the time gap will fill. It filled there. What happened after it filled? Reversed. Another gap right here. Filled right here. Reversed. Boom, boom, boom. Over and over again, 80% of the time. If you don't believe me, I don't expect you to take my word for it, but go out and look at any chart. Look at any 10 charts randomly. Look at the gaps. Look at how many times they fill, and look at how many times they reverse after they fill, and you'll see how this 80-20 rule applies to gaps as magnets and signals. It's amazing how often this happens. Now, there's my picture of the chart on the drawing board. Now, in my example of legging in, look at my example. I am taking the same exact position that I did in the first example, where I'm buying the stock at 40. What I'm doing after that is I'm waiting for the stock to rally with the target price up around the gap. And then when the gap is reached, I will then sell my $45 calls. I don't see any more questions, so I'm going to move on to the next slide. Boom, here it is. Legging the covered call. I'm buying the stock at 40. Step 2, I'm waiting for the stock to rally. Step 3, I'm selling the call now at $4 instead of $2. And what did I do by waiting and getting the higher price? I've lowered my cost basis of the stock from originally 38 to 36 now. See that? So my risk has been lowered a little bit. My risk is still to the downside, which is a net debit. But now I've got myself in a better position. If the stock continues to go past 45, I hit a home run. I sell the stock at 45, collect $4 in the process, and I wind up making $9 on the trade, and I'm a happy camper. It's really that simple. Now, again, these are examples. Does it always happen this way? And is it as easy as I'm making it seem? No. Here's why. I have to back up. If I'm legging into the trade and I see all of these signals showing bullish signs, what am I going to do if all of a sudden the stock drops down below the 20-period moving average? What do you think I'm going to do? Who wants to volunteer an answer? If I'm legging into the trade because I see this big, beautiful green candle, and the stock now closes below the 20-period moving average the very next day, what am I going to do? Can anyone tell me? I know there's that lag time, but I don't see an answer. I'm just going to volunteer the answer myself. Oh, there we go. Yep, sell. Exactly. I'm going to get out. I'm going to take a minimal loss. I'm going to get out, and I'll start again another time. Remember, our risk is to the downside. So, as responsible traders who are holding ourselves accountable to our own accounts, we need to manage risk. If the trade doesn't proceed in a positive direction, I need to quickly, without thinking about it, quickly end the trade, move back to cash, minimize the loss, move on to the next trade. It's as simple as that, you see? So that's what we do. Now, I'm looking at time. We're right on schedule, absolutely right on schedule. Now, if you look at the vertical call spread, this is a little bit different than the covered call, obviously. It is a bullish strategy. a vertical call spread in this example is a bullish strategy, where instead of the stock, like I did in the first example, buying the stock at 40, I'm buying an option that represents the long position. I'm not going to get into the minute details of how I got into the pricing of this, but let me just say that when I'm doing a vertical call spread, I try to get them for $3 or less, because if I'm doing a bullish call spread like this, remember what I said before, I have a fixed amount of risk and I have a fixed amount of max profit. Those are both fixed. My risk is fixed, my profit is fixed. So if I'm looking to do a call spread like this, I usually don't like to do them for anything more than $3, because I don't want to risk that much in a particular trade if it goes against me. So in this example, I'm buying something that's getting me into a long position, and I'm selling part 2 simultaneously for a $3 debit. Now, I'm going to slow it down a little bit here for you. It's a bullish spread. What's my risk? The most I spend for the spread. The debit is what my risk. So in this case, I'm risking $3 per share. The most I could lose on this is what I pay for the spread. The risk is also to the downside. So in looking at a chart, and this is going to be a different chart, but same idea. It's a different chart. I'm using a different drawing board. The signals are similar to the first chart that I looked at with the covered call. Not exact, but this is another bullish position or technical situation that I wind up trading off of most of the time. In this example, you'll notice that the stock is not crossing over the 20-period moving average. It hasn't crossed over that yet. However, I do see a good strong green candle, and I see that the volume is increasing on that green candle. So those are 2 counts that I pay very close attention to. Remember, the color of the candle tells us who's in control, the buyers. The volume tells us or measures the force behind the buy side. So the increase in volume is actually a leading indicator for me. The other thing that I'm looking at is, you see this horizontal line that I've drawn here? That's a line of support. I drew it from this low in a horizontal fashion. So I can see that the low from back here is being tested once again, and it looks as though the buyers are successfully rallying the stock off of that support level. So that's a positive sign. The other thing you'll notice is that down here in the stochastics, and Eden, you could pay close attention to this because it seems like you know a little bit about stochastics. The cross has not occurred yet. You see that? However, this blue line, which is known as the %K, that's giving me a reading of oversold. And let me just pause a little bit to explain this whole indicator to you. You'll notice that there are 2 parallel lines here. You see this? Now, what I don't have on the chart is that there's a scale that's usually measured on the right axis, and that is a scale that measures from 0 to 100. So the very bottom of the indicator is 0. The very top of this indicator is 100. These 2 parallel lines measure 20 and 80 on that scale. So when a stock is dropping well below 20, that's telling us that the stock is being defined, it's being defined as being oversold. Now, I'm not afraid to jump into a stock before the buy signal happens when I see the stochastic, the K line starting to go up. You see, the K line starting to move up is telling us that the momentum is shifting to the upside. And you'll notice that on almost every single time when the stock has dropped below 20 and then started to move up over 20, see back here it went below 20 and started moving over 20. Look what happened to the stock when it started moving out of the oversold area here. You see, here it started moving out of the oversold area. Boom, there's a beautiful rally. That's an up leg right there. Here, Look, it went oversold, but stayed oversold. You see this? It stayed oversold, but when it started going over 20, it had given us a buy signal, and boom, look at how it rallied. This one, it touched 20 and then started to pivot higher, rallied. Here, again, it touched 20, pivoted higher, it rallied. Here, it touched 20, and then it pivoted higher and rallied. So I think by looking at the evidence here, or weighing the evidence, it's safe to say that the odds are in favor of a rally from this point on, right? Now, could the stochastics be wrong? Could I be wrong? Could I make a mistake and buy it and then have the stock go down? Sure, absolutely. Remember I said there's no guarantee. But when we're looking at the technical charts, and when we do a good job of weighing the evidence on the buy side or the sell side, it's clear that the buying evidence, or the evidence of buyers coming in, far outweighs any evidence of selling activity. So everything here is telling me buy it. All right. Now let's go into the example of what it would be like to leg the vertical spread. Now, listen, again, for those of you who have never even looked at an option strategy before, don't worry. I say, first, fall in love with the chart. Fall in love with the mechanics of how we analyze a price chart. Fall in love with the idea that a candle chart is giving us clues. Get excited about the idea that this can actually put the odds in your favor. Get excited about that, because I'm telling you right now, you turn on any of the financial programs, there isn't anyone that shows up as a guest. There isn't a single person that's going to give you more evidence for a rally or a sell-off than a chart will. They won't. The analysts that come on these financial programs are going to look at the fundamentals. They're going to look at the earnings per share. They're going to look at the debt to equity ratio, blah, blah, blah. They're going to look at all the fundamental stories and tell you how great the company is, and how Elon Musk, being removed as CEO is a bullish thing. They're going to give you the whole story, right? But the charts tell us something, and in fact, doesn't tell you one thing. It tells you many things about what the mindset is of the community of investors that are involving themselves with the stock. That's the whole point of looking at the chart. So fall in love with the process, and while you're falling in love with the process, understand that if the signals turn on a dime and start moving against you, there is no need to hold on anymore. Okay? So that is very, very important. So, all right, let's get back to the example. Legging the vertical spread. Step one, buy the $35 calls, which is what I'm doing in the first part anyway. I'm going to buy those for 7. I'm going to wait for the stock to rally. And then when the signals start weighing more to showing us selling activity, that's when I will go to step 3 and then sell the $40 calls for 5. So our goal here is to get a better price on the spread as I'm doing it. So remember, in the first example, I was paying $3. In this example, by legging the spread and doing it correctly, and if all works out as planned, I'm getting the spread for $2 and dramatically reducing my risk by 33% of what the first example looked like in doing it for $3. So again, my risk is to the downside, and the most I could potentially lose is $2. All right, we got that so far? I'm going to try to slow it down a little bit, because the next example that I'm going to talk about here involves a little bit more in strategy, and it's going to take a little bit more knowledge to understand the mechanics of how this works. Okay, and please, I'm not going to beg you for questions, but I am certainly going to invite you to throw questions here. And here, there's a couple of reasons why I want you to ask questions. Is because there are going to be people listening to this recording that aren't able to ask me the question, that might be on your mind now. So you're actually helping the people that are listening to the recording by posting a question. Because like I said, they're not going to be able to ask me the question like you can in the live audience. So go right ahead. Now, the diagonal spread, when I try to explain this to people, is I call it a cousin of the buy right. Now, let me explain why. In a buy right, step one involves buying the stock, right? And in the first example that I did in the buy right or the covered call, I'm buying the stock at $40. The only difference between the buy right and what we see here in a diagonal calendar spread is that I'm replacing the long stock position with something that looks and feels and almost acts just like the stock itself. You see? So I'm taking out the stock and I'm replacing it with a LEAP, a long-term equity anticipation security. That's what LEAP stands for. So I'm buying the LEAP for $20, which is half the price of what I was going to spend on the stock for $40, and I'm collecting the same $2 that I did when we sold the $45 call in the covered call. Hope I didn't lose you on that, all right, because that's an important point. If I lost you, say, AJ, please repeat that, and I will, all right? Now, step one involves buying the LEAP or something that acts like the stock. Step two involves selling the front month call. Again, I didn't put a month on here, but generally what I'm doing is I'm selling the next option month, and I'm usually selling an at the money or slightly out of the money call. For those that understand option terminology, I'm usually selling an at the money or slightly out of the money call. I'm collecting $2. Now, when I sell this call, I'm immediately lowering my cost basis up the LEAP. You see that? I'm lowering it from $20 to what? 18, because I'm getting paid money to do that. So my net debit is $18, which is, by the way, my risk amount. You see that? So risk to the downside. What am I risking? The net debit of the whole transaction. That's what I'm risking. All right, now let's go to the slides. And this is where it's going to get really interesting. I have to time this just right because I want to show you some actual trades. This is a different chart, okay? It's really like a combination of all the other things that I've shown you thus far. First, I can see there is a role reversal support level. Very powerful horizontal line right there that, by the way, I have a video on in the Market Guy website library. Go to the library. There's a video called The Role Reversal. Understand that. This line right here and knowing how to draw that line is what made me $1 million in the silver markets back in the early 80s. Right there. Knowing how to draw a horizontal line from former resistance that was broken turning into support. Very, very powerful concept of role reversal. So I see that the stock is bouncing off of this role reversal support. If I'm going to label this as positive, negative, bullish, or bearish, what is it? It's a positive bullish sign. It's bouncing. Number two, you can see there's a bullish engulfing pattern there, or very close to one. That's positive. Weigh the evidence. Number three, the green candle is showing a close over the 20-period moving average. Remember Jim Robach? That's positive. You look down, volume is increasing on a green candle. That's positive. The stochastics is crossing, and the K line is still going up. That's positive. So on all counts, with maybe even saying this is still an open gap up here, all of the evidence that I'm looking at is weighing in on the buy side. I love it. So instead of me doing the trade simultaneously, like I could have in the first example, I'm going to now leg into it. Where step one is still the same. I'm going to buy the LEAP for $20. However, I'm going to wait now because I think the stock is going to go up. And you know, folks, even if you only wait one more day and wait for one extra green candle, you're still going to get better price than what we had here in the first round of selling it for $2. You might even get $2.50. Maybe you get $3. In this example, I'm saying we're going to get $4. Again, it's an example, out of the hat number to show you what our goal is. Now, selling the same $45 call at $4 lowers my cost basis now from 20 to 16. You see that? Now, if you leg into a diagonal calendar spread and it goes in your favor, like in this example, it's going to be extremely difficult for you to lose money on this trade now. Because what happens now is if the stock drops down after you've legged in this great price right here, you could still make money on the way down. I've had that happen to me where I legged in. The initial transaction was a leg into a diagonal spread like this. And the stock dropped after that, and I was still able to make money. I'm not going to get into the exact steps of what to do when the stock drops after you've legged in, but these are the things that I'll be covering at the option event in Chicago. I promise you, I'm going to show you things that only the professionals know and things that you will not know or learn about in any option course that you take. You won't, because I'm going to share. I'm not going to say these are trade secrets. It's just that there are very few people on the planet that even know how to do this, let alone teach it. Okay? So this gets very exciting when you start combining option strategy with technical analysis. You see? Now, in review of the stochastics, this is just a quick snapshot of what it looks like when the buy signal occurs after a stock is oversold. Here, look at what happened to the stock. It rallied. Here, it went overbought. Remember, over 80 is overbought, and then it crossed. So here would have been a get out point. Here would have been a new entry point. Here would have been a sell point. Here, if you didn't sell all of it the first time, you would have sold it here. Here would have been another buy point. Here would have been a sell point, right? So the stochastics is very powerful as a complementary tool to what you're looking at on the chart itself. Now, Angela says when the stochastic is crossing, then it's a signal. Well, actually, Angela, when it crosses, when it crosses on the downside below 20, that's a buy signal. When it crosses and it's above 80 up here, that's a sell signal. However, the stochastic, the K line, the blue line, will often give a change or a signal in the change of momentum. See, I'm very, very quick to jump the gun on stochastic as long as I have a supporting candle that's giving me a good, strong buy signal. So, in other words, if I see a good, strong buy signal on the candle, I don't put as much weight in the stochastics because the candles are giving us the clues. The stochastics is measuring the candle or the momentum or the change in the momentum of the candle. So I don't want to confuse you there, but the weight is carried more in the price and the volume. The stochastic is a complementary indicator. Okay. Now, in this slide, again, if you want this this PowerPoint email to you, go to the Market Guys, or I'll give you my email address at the end. Just say, AJ, please send me the file. You know, boom, there you go, and I'll send it to you. So it's aj@themarketguides.com. That's it, aj@themarketguides. And I'll send you this. Now, when you get this presentation, print this slide out. Print it out and go to one of the office stores or Walmart or wherever, and get some of those laminated page protectors and put it in there and use this as a guide. I would say put it on the wall in your office, put it under your desk blotter, tape it to your monitor on your computer. I don't care. These are the things that I look for without stochastics. Remember what I said before. The stochastic is a supporting tool. These are the signals that I look for on the chart. With the exception of gaps, which are not mentioned on this, these are the things that I look for, okay? Especially the engulfing patterns. Very, very powerful. Now, John says that third stochastic bunched together gave very nice momentum signal as well. Let me go back and look at that. The third stochastic, this one here, is that what you're referring to, John? Yeah. See, there's times where a stock is in an upward trend, and the stochastic will continue to stay overbought, you see? Now, here's an example where we had a bearish engulfing pattern right there. You see this? That again, trumps all of the stochastics down here. I would have, if I had a long position back here, I would have been almost completely out here. Even if the stock went higher, I wouldn't have cared. I would have made money on that leg. All right. I may have gotten in on this hammer pattern, even though the stochastics is higher. I might have gotten in, no telling, but I look for these legs to make money on. Okay. Hopefully that helps you, John. All right. Now, here's what I'm going to do. Let me just fast forward because I have a live screen. Let me just fast forward to this so that you have my email address. If you want to just jot that down again, it's AJ at the Market Guys. If you want a copy of my trade alert, I'm going to be putting one out either tomorrow or Thursday. I have to wait for the market to give me the signal. But most of the time, I'm putting the trade alerts out on Wednesday or Thursday. And then Friday, I put out a market report that analyzes the week's action. Okay? So there is my email address. And if you want, just send me an email. Now, here's what I'm going to do. This is the first time I'm doing this, so bear with me. This is the first time I'm actually sharing my screen with the audience. Okay, so let's see if this works. Don, if you could tell me when this is showing up. I think it is showing up. And I live. Is everyone seeing this right now? Don, if you could, please, please just chime in with a question, because I going to this live screen, I am not seeing the Q&A box at this point. So if everyone could just follow along. Now, these are actual trades. This is my trade blotter just for the past 6 weeks, just to show you how effective this is. Now, on August 14th, notice the number of contracts that I'm trading. I'm not trading like thousands of option contracts. I'm either trading 10 or 20 option contracts at a time. Rarely do I go over 20. Rarely. Okay, just so you understand, I don't trade enormous amounts, but I want to show you the power of what even moderate positions can do for you. Okay, so on August 14th, this is a diagonal calendar spread. All right, on August 14th, I bought the January leaps at the 200 strike. All right. This BCO means buy calls to open. This is my actual trade blotter, because what I do, I don't rely on the broker's accounting skills to help me track my positions. I have to transpose everything that I get from my online account to a spreadsheet where I can see it all at a glance, so I know what my positions are. Okay. So on August 14th, I bought calls to open, and I paid $43 for those. Very, very close to what my example was. Except in my example, I paid $20, right? Remember that? Now, 2 days later, because the signals were bullish on August 14th, I legged into these calls. 2 days later, I collected $4 because the stock rallied up after that. See? So what I did is I bought the calls for 43. I lowered my cost basis immediately to 39. You see that? And then what I did, as I followed the technical signals, I kept rolling the position. September, October. On this day, it looked a little. It looked like the signals were changing. So I bought my calls back, and I sold. The new position. So what I did is I rolled up. This should have been SCC. So calls to close. That's a mistake there. And then I bought calls to close. Now, the net, when I closed the position on September 26th, this was my actual profit on a 20 contract position. You see that? That's a huge percentage of gain when you look at the original amount spent on this trade. This is an actual profit. Now, you notice my closed positions. Next to each one of the closed positions is the amount I took in profit. See, this was a small position. This was just buying the stock and selling it for it. I bought for it, sold for it on the technical signals, made a quick, just in 7 days, made a quick $1,700. Here I traded for it again, right? Made a quick $280. Here I'm trading Ford. You see that? I like Ford. It was following the signals perfectly. Here I trade FCX, Freeport McMoran, follows the signals perfectly. If I scroll down, you'll see there's another. This is my only loser, by the way, out of this whole spreadsheet. See all it's green, 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 right? You see that? Oh, why my screen just froze up? This is the only loss that I've had in 6 weeks. The only loss. Now, again, going back to my legging into the calendar spread, why did I close out of it after it was doing so great? Why did I buy these calls back and sell these calls to close? Why did I get out on September 26th? Well, that's because this is a bullish strategy. Remember, when you buy a leap, sell a call in a diagonal calendar spread, that is a bullish strategy. So on September 26th, I was not happy with the signals on the chart. In other words, they were no longer looking bullish. So I made the decision to close position, take the profits, run, and that was the best decision because shortly after that, Baidu started selling off. You see? So that is trading according to the technical signals in a nutshell, and hopefully, you know, you got enough out of this to really at least get your, you know, wet your whistle in how to get this going. So I'm going to stop sharing right here. It says stop sharing, and I'm going to go back to the slides so that you have this. Now, again, I'm looking at some questions. Stephanie says, do you do a pattern? I don't see the whole question there, Stephanie. Let me click on this. Okay, Don, I don't see a whole question from Stephanie. I just, do you do a pattern? Okay. Oh, do you do a pattern of buying and selling the same calls? Not in a straight buy sell like I'm swing trading the options. However, with SLV, I do that. Silver, because I've been trading silver since 1982. I feel very good. So there you go. I kind of jumped the gun and answered your question. SLV trades very much with the signals. In fact, the last presentation I did, which was on our Monday night call last Monday, I talked about silver, and I don't know if you looked at what happened to SLV over the past couple of days, but it had a huge spike as it broke out and closed over the 20-period moving average. And I made good money today on SLV. In fact, I sold my SLV position today because it had gapped up, and I was expecting the gap to pull back. And guess what happened? It was later for a profit, and that's totally up to you. However, I wouldn't try to day trade options. Not a good idea. Mainly because the markets are not as tight with regard to the bid and ask spread like the stock is. When the option is trading a penny difference between the bid and the ask, then maybe you could do that. But if you're trying to day trade options, you may not get enough volatility to justify the spread between the bid and the ask. Okay? And Angela, yes, I do apply the stochastics on the daily chart as well, and you can do that yourself. So with that said, I invite all of you to follow me on themarketguys.com. If you'd like to subscribe to my weekly market report, that's free. You can do that. Again, if you want a sample of my actual trade alerts that go out to my clients, I'll be happy to send you that. And if you have any additional questions, just send them to me. Right there is my email, AJ@themarketguys. And I certainly didn't run out of content. I just ran out of time. So with that, I'm going to pass it back to Don, and I will see you in Chicago. Take care. Back to you, Don.